Good morning, and thank you all for joining. Today we have a very special webinar for you all, which is how to navigate retirement as a single retiree. And we've received numerous requests over the years to put together a presentation with this as the main topic. So here we are today. And really what this workshop is going to help you with is it's going to help you better understand some of the unique decisions that single individuals are faced with in retirement, as well as many of the strategies that may be applicable to them. But before getting into the meat of today's topic, let me give you an overview of my team, what we do for those that don't work with us. And always, I do like to mention that any tax strategies we'll review today should be reviewed with the CPA or your tax advisor to ensure that it fits within your unique situation. Now, on to us. We're a boutique wealth management and financial planning firm here in beautiful Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, many of whom are on the line with us today, is we work with them with their holistic financial planning and their investment management needs. We find personally that our industry is just too focused on the investment side of planning. So what we've done is we've made it a priority to take both a comprehensive and holistic approach to planning and then to continuously educate, which is one of the reasons why we host this webinar series. Now, our process involves building well-designed financial plans, organizing our clients' investments in direct coordination with their plan, and then ensuring that any outside financial planning items have been handled. And that may involve our collaboration with other professionals like CPAs, attorneys, or really anyone within our client's advisory team. And here's a quick overview of our team. We have 7 planners. We have a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's get into today's topic. And for today's conversation, we're going to be focused on the 3 main areas of the planning pyramid shown here, which are retirement, organization, and control, and then less worry. And for our agenda, we're going to first review retirement income and discuss how retiring single may affect your long-term retirement distribution plan. There are many assets that one can draw from in retirement, and it is imperative that you coordinate those assets and the distributions from those assets correctly given your unique and individualized needs. Next, we're going to discuss some of the specifics of long-term care and review what single retirees should consider in regard to their own long-term care planning. We'll then review estate planning, then get into some of the specifics of building a proper retirement plan. And at the end of the webinar, you should have hopefully gained valuable insights over many of the unique circumstances that single individuals are faced with, along with some of the strategies available to help overcome those circumstances. So without further ado, let's jump right into the conversation by reviewing retirement income. And specifically, we will be reviewing the strategies available to help stretch your income producing assets, specifically as an individual, a single individual. And ultimately, that should help in providing you with somewhat of an enhanced level of retirement security. And the first thing to review is many of the retirement income sources that are shown here. The 6 that I've listed, in my opinion, are the most commonly used assets in retirement to fund just your day-to-day lifestyle. Cash and non-retirement assets, retirement accounts, passive income through various ventures, Social Security, life annuities, and then home equity often play major roles in supplying your day-to-day cash. And the strategies associated with the first 3 listed really don't change much, whether you're single or married in retirement. However, the strategies for the 3 on the right often do, so that's what I'm going to discuss first. And essentially, as a single retiree, you only have to worry about yourself, and you only need to worry about your assets lasting your lifetime, generally speaking, of course. But often those that are married, they might have an age gap, they might have health differences, or other factors that affect their distribution strategy. But those that are single, they're really usually focusing on themselves. So for the most part, the primary objective is the longevity of their assets for their lifetime. So these 3 assets, the 3 on the right, all have unique characteristics that can help provide a more, once again, enhanced level of security in retirement. So let's start with Social Security. And first, I want to discuss some of the specifics that you should be aware of on the left. First off, Social Security is a fairly tax advantaged vehicle compared to, let's say, your IRAs or 401ks. Only up to 85% of the benefit will be taxable federally, and most states, including my state of California, they do not tax the benefit. So comparing, let's say, a $40,000 income from Social Security versus $40,000 of income from an IRA distribution, the Social Security benefit will most likely have less of a tax liability, leaving more money for you to spend. Additionally, your benefit from Social Security actually grows about 8% every year that you wait to withdraw. The earliest you can withdraw is 62, the latest is 70. So for every year after age 62 that you wait to turn on your benefit, you essentially get about an 8% increase in your benefit. Most investments do not offer guaranteed rates of return, let alone a return as high as 8%. So by postponing your benefit and just pulling from other assets potentially, it may benefit you in the long run. And lastly, after you claim Social Security, you do receive what's called a cost of living adjustment each year off of your benefit. And what is important to know is it is a percentage of your benefit. It is not a dollar amount. So for those that postpone their benefit and have a larger monthly benefit, they actually get a larger increase in their benefit each year based off of that cost of living adjustment. Now, the main negative to waiting and waiting on claiming your Social Security benefit is that you're going to have less cash flow prior to claiming. And now that's obvious, but that just is why financial planning is important. So you can review all this in advance. So how does all of this play into retiring single? Well, think about it. If you are single and you just need to worry about yourself and your cash flow, then ask yourself this. Wouldn't it make a lot of sense, in most cases, to postpone pulling as long as possible so you can lock in that high benefit for life? No one can time the financial markets, so throughout retirement, your portfolio may fluctuate drastically. But when you have certain, I don't want to call them guarantees, but certain backings by the US government that they are going to pay you your Social Security check, it may provide not only greater security, but also that enhanced level of comfort that we had talked about earlier. And this conversation also leads me to the next slide, which is understanding life annuities. And life annuities are very similar to Social Security in that they provide you a stream of income, potentially for life, but instead of the government paying you, a life annuity actually has an insurance company pay you. And essentially how these investments work, in the simplest way to put it, because they are somewhat complex, is you exchange your money, whether it be a lump sum or periodic payments, to an insurance company, and then they pay you a stream of income for life that you can't outlive, so long as, of course, that the insurance company has the ability to pay you. And how you can think about these types of investments is essentially longevity insurance. Why do people buy life insurance? Well, they buy it to protect their family financially from an unforeseen death. Why do people buy life annuities? Well, to protect themselves financially from living a very long, healthy life and potentially running out of money. Now, there are negatives to this type of strategy, though. As many people are aware, annuities are insurance products and have additional costs associated with them. Often these products may not be liquid, or accessing your policy may also affect certain guarantees that you have within the product, and the guarantees, of course, being the income for life. And then lastly, the investment options with the products may be limited compared to, let's just say, investing on your own with a different custodian of your assets. But with all of that being said, though, for those that are single, these generally may be more of an attractive offering because you're really only focused on your financial longevity, not necessarily your spouse's. For example, if you are married and you buy a life annuity, usually that's going to be a joint life annuity for you and your spouse. And generally speaking, the insurance company will pay you both less income because there's more risk on the insurance side of things. Additionally, if you're not concerned about leaving a significant amount of money after you pass, then it may benefit you to, if you're single, to essentially take some of your chips off the table. And what you're doing, in a sense, is passing on some of that financial risk of living a long life, or having your investments fluctuate too much. You're passing on that risk to an insurance company. But all in all, like anything in life, there are trade-offs to these types of investments. So I advise you to never jump into anything without first weighing both the benefits and the negatives to the strategy. And now that leads me to the last section on retirement income, which is the equity in your home. And often people don't consider their home as a retirement vehicle, but many times your home is the single largest asset on your balance sheet. And it is an asset that you do have access to if you want to utilize it. Whether it be a cash out refinance, where essentially you reset your mortgage and you pull cash out of your home for you to use, or a home equity line of credit, where you temporarily borrow money from your house, causing you to pay an interest only loan, or even a reverse mortgage, where essentially a bank will slowly buy your house off of you. You do have plenty of options on how to use your home to your advantage while you're alive. But what is important to know is that these strategies can be somewhat costly to you, and they can get complex. But just know, if you're one of those Californians with $1 million home that's fully paid off in retirement, and you either don't have anyone to pass it on to, or you're just not as concerned about leaving a legacy to your heirs, then understand that your home is a huge asset. And if you want to use the value within it to improve your standard of living, then you have options to do so. But I'll leave it at that and summarize this section by saying, as a single retiree, generally, you're looking out for yourself. And if you're not too concerned about leaving that legacy, which would just be money to your heirs upon you passing, then there are some creative strategies to not only increase your cash flow while alive, but also to provide more security in the event that you were to live a long and healthy life and were to pass at an age much later than your initial financial planning called for. Now, if you have questions, please hang tight. I'm going to be opening it up at the end. But what I want to do now is segue to understanding long-term care planning. In long-term care planning, it changes when you're single, because unless you have family around the corner, then you might not necessarily have someone who can assist you with your ongoing care in the event that you needed assistance. Many married couples end up assisting each other in the event that one of the individuals needed care. And while that may not always be the best plan, single individuals just don't have that luxury. So what I want to do is fully review what exactly long-term care is, and then we can discuss what you might want to think about in regard to your own long-term care planning. And if you're unaware, long-term care is the need for assistance with the activities of daily living, which are eating, bathing, dressing, toileting, transferring, and continence. And generally speaking, you could be considered in need of long-term care assistance if you need, if you have two of these conditions, or if you have a severe cognitive impairment, such as dementia or Alzheimer's. And what's important to note is that long-term care is drastically different than health insurance. Health insurance coverage is designed to get you better and to assist with things that cannot be done at a hospital or a doctor's office. Long-term care is more or less maintaining your independence as you age. Because as anyone knows who has had an elderly parent or grandparent go through a long-term care event, generally their needs increase as they age. And often long-term care in some capacity is required. So some surprising facts around long-term care. First off, 50% of Americans who turn 65 will need care at some point in their lives. And if you require nursing home care, the average stay is about 2 to 3 years in that facility, with about 15% of patients staying for over 5 years. And what is important to note is long-term care doesn't, I'm going to rephrase that. Long-term care doesn't decrease, or your likelihood of needing long-term care doesn't necessarily decrease if you live a healthy lifestyle. Often people think that if you're living a healthy lifestyle, your care needs will be less. But what often happens is that those that are healthier, they live longer lives. And if you live longer lives, often you're going to need more care when you're in your late 80s, early 90s, maybe even your late 90s or 100s. And often people who are married, they think that their spouse is their long-term care. Like I mentioned earlier, if you're married, you have that luxury. If you're single, you don't. And 50% of people who are married say that their spouse is their long-term care plan. So really, what does this all show you? Well, this is not to scare you, but it is to make you aware that those in retirement often have long-term care events. And if you're navigating retirement as a single individual, you do have some unique planning to consider to ensure that you're protecting not only your health, but also your wealth. But what does this type of care look like? Well, it's on a spectrum. And the type of care provided really depends on the needs of the individual. Often when people age, they may need home health care or adult daycare services. Home health care often involves someone coming to your house and assisting with your day-to-day needs, maybe even getting your medication ready, helping around the house. And adult daycare would be a place where someone may go for a short period of time to potentially give their caregiver maybe some time off during the day, maybe a break through the day. Assisted living facilities are often a place where individuals go to maintain a sense of independence while also having services provided to them that they may not be able to do on their own. In my eyes, it's kind of like a step down from a nursing home, and that's next on the spectrum of care. Nursing homes often provide that around the clock care, and they often provide an enhanced level of care compared to, let's say, an assisted living facility. And then lastly, there is hospice care, which is the end of life care for those that are terminally ill. And what is different about those that are single is that needing to use one of these facilities potentially will happen earlier compared to someone in a similar situation because, as I mentioned earlier, their spouse may be able to assist with their needs. Whether it's hiring someone around the house early on to assist or potentially moving into a facility, single individuals often face more expenses, and those expenses can be costly. So in California, the average cost of a skilled nursing home facility is around $135,000 for a one bed, and the average monthly cost for a one bedroom in a residential care facility is around $5,700. Lastly, the average hourly rate for an in-home aide is about $30 an hour, and you usually don't pay for just 1 hour. I believe you have to either pay for a half day or a full day, so it can be a costly event if you need that on a regular basis. So as you can see, though, these costs can add up fairly quickly depending on when you need the care. So what does this all mean for you? Well, my advice is simple. Have a plan and incorporate it within your holistic retirement plan. There are plenty of ways to cover care. It could be through the assistance of your family, insurance policies, your retirement portfolio, or maybe even the equity in your home. What is important, though, is that you have thought through this type of contingency and you have put a plan together that will account for any unexpected costs. So today I don't really have a specific recommendation for you. And this is definitely not a pitch for insurance because that might not be right. But what I am recommending is just a plan for it. Now, we'll talk a little bit more about this at the end, but we still have 2 sections to go. So let's move on to the next section, which is understanding estate planning as a single retiree. And estate planning is imperative, especially if you own a home or you have a sizable net worth. But today I'm really going to focus on what single individuals should be thinking about in regard to their estate planning needs. And first and foremost, any elderly individual that is single should have assigned a trusted contact on all of their bank and all of their investment accounts. Essentially, a trusted contact is someone who you can rely on to act in your best interest. And the importance of having a trusted contact is so that if you were in a situation where your advisor, broker, or banker thought something was afoot with your account, then they could contact this individual. For example, elderly individuals are the most susceptible to financial scams. And if your advisor would think that you may be in a situation where you're being scammed, they could reach out to your trusted contact. Additionally, dementia and Alzheimer's can cause serious issues, including financial issues, without any family members noticing. So by assigning a trusted contact, you may be protecting yourself in the event of an illness. Now moving on, you should also ensure that at a minimum, you have in place power of attorney documents, both financial and health related. What a power of attorney document will do is it will allow someone to make decisions on your behalf in case you're incapacitated. So if you're in the hospital recovering from some unforeseen accident or illness, a close friend or family member would be able to assist from a financial standpoint, as well as help to make healthcare related decisions for you. Whether that be deciding on some of the care needs from your doctor, managing your bills, or something else, these documents will ensure that you have a voice in the event that you're unable to speak for yourself. Additionally, and this is just good planning in general, you most likely will also want to have a will and a trust in place. I'm not going to get into all the details of this now, as this side of estate planning is completely separate from the conversation we're having today. But by having these documents in place and properly titling your assets, you'll ensure that they get passed to your desired heirs in a manner that you wish for, as well as ensuring that your assets avoid probate, which can be a very costly and cumbersome process for your family. So to summarize the estate planning section, just be certain you have documents in place to ensure that you're protected from both a health-related issue that could have you incapacitated, as well as an issue that could have you making ill-advised financial decisions. So on to the last section then. And it's building a comprehensive retirement plan. Whether you are single or married, it is always advisable to build a retirement plan to ensure that you're navigating retirement in the most efficient manner. This could help provide more security by ensuring you're utilizing your assets most efficiently, as well as can help you plan for what may be most important to you in life, like travel or maybe gifting to charities. And this section will really summarize everything that we've talked about today, because all of these strategies related to being single and retirement also go into building a proper financial plan and a proper retirement distribution plan. And the first step to planning is always setting your SMART goals. The reason you need to think through your goals and objectives is that dependent on what you're looking to achieve will affect your long-term planning. For example, many of the strategies that I discussed regarding retirement income today wouldn't necessarily apply to you if one of your objectives was to leave the largest legacy possible to your heirs. On the other hand, if you are only focused on your personal financial security, then many of the strategies would be applicable to you. So the first step is to think through your objectives. And the reason you want to set SMART goals is because specific and measurable goals can really be built around a financial plan. For example, if your objective is to travel in retirement, set some parameters around that objective and then build it into your financial model. If you wish to spend $10,000 a year traveling, put that into your plan. And when it comes to your retirement modeling, here are the applicable steps to building out the proper model. First, after clarifying your objectives, you'll want to get organized and you'll want to review your balance sheet and to review your expenses. Once reviewed, you'll then be able to project outward. And generally speaking, when you model out your income, expenses, and assets, you do want to use some conservative assumptions. For example, your portfolio over the last 20 years may have received a 7% rate of return, but who the heck knows where the market's going to go over the next 15 years in retirement? So maybe use a 4 or a 5% rate of return. Inflation has historically been around 2 to 2.5%, but maybe you use 3% in your planning to be conservative. The reason you use conservative assumptions is because no one, not myself or the best Wall Street individuals, can predict the future. So by planning conservatively, you'll set yourself up for a higher likelihood of success. And lastly, you will want to review and you'll want to adjust your plan as things change, because no one can predict everything perfectly from the beginning. So by reviewing and adjusting, you're consistently staying top of your planning. And here's just a quick example of some of the modeling that we would do. As you can see on the left, you would want to properly organize all of your assets, whether that be cash, investments, retirement accounts, insurance policies, or annuities. They're all going to play into your retirement, so you should account for them. Next, in the middle and the right, you'll model everything in an organized fashion. You see within this model that there are 3 sections. First, assets, then income sources, then expenses. By properly listing and projecting all of this out, you'll be able to see if your assets are projected to last your entire retirement, And this can help you understand if you may be over or underspending at the onset of retirement, and will help you make smart decisions today that will help your future. But the growth of your investments within your plan, really, it's only as solid as your investment strategy and your asset allocation. So along with this type of modeling, you're also going to want to complete a detailed analysis of your investments, and to ensure that you're investing in, or I guess, according to your time horizon and your risk tolerance. And the reason this is important is because in retirement, often retirees are looking for more consistent and stable returns than they used to receive during their working years. So your strategy during your working years may be drastically different now than what it was. I'm sorry, your strategy now may be drastically different than it was during your accumulation years. So you should spend the necessary time truly understanding your portfolio, as well as the financial needs from your portfolio, so you can put together a proper investment policy statement. And what this is really the parameters and the guidelines for your investment strategy. It's more or less your roadmap to investing, and it ensures that your investments are in line with your risk tolerance, and it helps to solidify your investment goals and objectives. It helps to clarify your allocation that you should be targeting from an asset class perspective, as well as it helps you understand any specific or unique circumstances that may be specific to your planning rather than someone else's planning. And I always say, no coach goes onto the field without a game plan, and no captain goes out to sea without their chart mapped out. So why would an investor go into retirement without a proper investment strategy tailored to their unique plan? But to summarize everything, once you've reviewed your goals, once you've built out that base financial model, and once you've determined your investment strategy, the final step to planning is always to implement any next steps applicable to your financial plan. What I'm showing you here is just an example of an implementation agenda that we may have for a client. And what it shows is the general observations from their planning, the general recommendations that we've derived from their planning, and then it clearly lists out the implementation plan. And that's truly is the financial plan, because that is the actionable next steps. So whether you're building a plan on your own or working with an advisor like us, what is important is you do more than just the modeling. You want to fine-tune your plan as much as possible. So by going through this entire exercise, you will know if you've done everything to the best of your ability to improve your future planning. And in our eyes, the entire exercise is really what planning is all about. So I'll end by saying, for those on the line that are clients, know that whenever life changes, whenever you get concerned about the markets, or whenever you just need to review, let us know. We can always update your plan or go through another review. Our job is to help you make smart financial decisions, so we're always available for you. And for those that aren't clients, just know our door is always open. If you'd like to talk to us about what a relationship with us would look like, or run some hypotheticals by us, our contact information is on the screen. Feel free to reach out. What I'm going to do now is close out, as I have to close out this recording before the Q&A. And for those on the line, stay tuned as we'll open it up for questions in just a minute here. But thanks for listening,